Good morning. We called all of you at 8 o'clock in the morning and you came. Thank you so much for being here. Welcome to Abraaj Week 2016. We're certainly looking forward to spending time with all of you, to talking about our business, to talking about our markets, to talk about some of the opportunities within them, and to talk about some of the challenges within them. It's not an easy time in the world. We hope that the first half of the day is spent talking about those opportunities and challenges, leaving in front of you a fairly clear picture of what, in our opinion, is the landscape that we all face. At the same time, in the second half of the day, we'll get a lot more focused with our investors, those of you who entrust us with your capital, and hopefully take you through what has been another stellar year at the Abraaj Group. You just saw a video in which we talked about some of the transactions and some of the businesses that we bought in 2015, some of the exits that we had in 2015. And as we go through the day, I hope you get a good sense and a feeling of all of the different things that we've been doing through the year. It's a week in which we hope to bring together all the different elements of our ecosystem and the discussion that I've just talked about concerning the trends that we're facing in this time. There's a wide mix of people that are in the room. There are stakeholders. We hope that we continue our collaboration with you. We hope that we continue the kind of dialogue that enables us to be who we are. One of the outcomes that we hope at the end of it is some form of consensus as to where we're going. The vantage point that we occupy when we look across the markets is something that we're particularly focused on always. We look at the macro, we look at the overall structure of the markets in which we operate, and hopefully get some sense of where we should be going next. We hope that you will provide input into us in helping us think through that. This is the first time that we've held all of the various events that we hold for our stakeholders at one time. As you know, in the past, we've done things in Istanbul, in Singapore, in London, and so on. What we actually wanted to do was to bring all of it together in 1 week and have you talk to each other, rather than having different audiences at different places at different times. Our LP advisory committee meetings are going to be happening this week, our investor forum, this event, and the most compelling of all, the backdrop of Art Week, which is now become an event which is a firm part of Dubai's social calendar. We started this along with Art Dubai about 10 years ago, and today it's one of the largest art events in the world. We hope that you will participate in that, go to that, and see the cultural vibrancy that is taking place across in global growth markets. What some people still, as I keep saying, mistakenly refer to as emerging markets. What you will see flies in the face of perception. And we hope that when you see it, you will realize that some of what you read in headlines is not true. You're in the Middle East. If you were sitting in Oklahoma City and reading a newspaper headline, you'd think that the Middle East is on fire. Elements of it are, but elements of it are not. The same can be said of almost anything in the world. You could cross the street in Chicago and get shot. On the other hand, you could be seeing a very different environment on the other side. So we hope that what this does is it enables you to open your eyes, participate with others, and benefit. And in a sense, that is indicative of the Abraaj story itself, because we have been developing a business in markets that the world for so long considered risky, and for so long thought were markets in which opportunity was stifled or stilted. And what we've proved over the course of the last decade and a half is that that is not the case, and we hope that you continue to be with us on that journey. This is going to be an interesting day. The first session after I finish talking to you will be about financial markets. Leading that discussion is going to be Anshu Jain. He's going to be in conversation with Nick Gowing, a famous broadcaster. As you know, it's very difficult to keep Nick from being focused on the conversation, and he keeps drilling down, but I hope he enjoys it. The one thing I do hope he talks to Anshu about is cricket. That was the bedrock on which he and I became friends a decade and a half ago, and I have to say, that the cricket T20 World Cup, which is about to come up in India, is going to be won by Pakistan. So sorry about that, Anju. I had the stage before you, so I had to say that. And before I hand over to them, I wanted to share my own views on what is happening in the markets, the state of play, and what it means for our current and our future investments. What does that mean? We're closing in at the end of the first quarter of 2016, and it's already shaping up to be as turbulent as 2015 was. It could be the price of oil, it could be the displacement of large populations, it could be the threat of violent non-state actors, or it could be looking to the United States. All of us are galvanized and enthralled by the drama that is being played out. It is like Hollywood has taken over, and there's a real sort of TV drama that is going on. The potential nomination of a presidential candidate with no political experience and a very, very turbulent point of view when it comes to the rest of the world. So the best way of characterizing the current environment that we see globally is uncertainty. Fundamentally, this is what we face, this is what we see. It's being driven by a number of factors, geopolitics, which for the first time, a lot of business people are realizing is the bedrock on which business is based. There are mixed economic indicators that are out there. Domestic elections across the world are on top of the list. Geopolitics itself is painting an extremely grim picture. The Syrian crisis is now entering its 5th year. Beyond the human suffering on the ground that affects each and every one of us in a different way, it's having widespread consequences in Turkey, in Europe, and elsewhere. Daesh, which is a group of extremely nihilistic extremists, is continuing to commit barbaric atrocities that are gripping our attention as much as we hate that. And Europe itself is at a crossroads. It's no longer about the Greek crisis. The Greek crisis has been amplified and is being exemplified by Brexit. It's a growing refugee crisis. Brexit is forcing Britain to face itself. Does it want to go back to being an island nation? Does it want to continue to be a part of the Committee of Nations? And I find it amazing that a prime minister at the height of his powers and with the largest electoral majority since Margaret Thatcher has allowed himself to get subjected and put this issue, which is of enormous consequence to Britain, in the hands of voters who arguably may discuss this issue in a patriotic fashion rather than a sensible and pragmatic manner. At a global level, as we all know, 60 million people are refugees today. That's greater than at any time, including the Second World War, where there were 40 million people who were displaced at the end of that war. Xenophobic voices are rising and are beginning actually to find the ability to be heard. That in itself is scary. That vociferousness is scary. In Asia, in the South China Sea, tensions haven't really abated, and the relationship between the Koreas continues to be a source of concern. In case that isn't enough to wake you up yet, that's just the start. I'm not trying to just paint a grim picture. I'm trying to paint the picture in which all of you, as business people, as members of civil society, are going to have to navigate the following year. Alongside all of that, financial and economic uncertainty is also reaching an unprecedentedly confused level. Equity markets are jittery. They're failing to respond in the way that European central bank regulators had hoped. You're going to hear more about that in the next session. The Fed is under global scrutiny, but seems to be caught in a damned if you do, damned if you don't situation, and continues to be focused, despite its preponderance, on issues within the United States. Oil prices seem to be recovering, but we can't tell. It's unclear where it's going to go. OPEC producers are favoring $50 a barrel, and experts continue to predict prices in the 20s. There is a global oversupply situation. Storage facilities are full. What are you going to produce and do next? Pump it into the sea? We don't know. China's slowdown is reported by the media on a daily basis. It's a hysteria. Everybody seems to be getting really caught up with what's happening in China. And recent emerging market capital outflows are indicating that markets continue to be worried about this fact. In lots and lots of Western countries, there continues to be an enormous amount of anxiety about domestic growth. Young adults are poorer than retirees for the first time. This is going to cause a social question to be brought forward that has never been brought before in economies that are dictated by providing equality on a social basis to their citizens. Young adults that have gone to university are unemployed, and hence we're also breaking the social contract of sending people to universities and expecting them to be better off compared to their parents. Inequality is increasing, and the latest economic indicators from the US are showing that even though job numbers are going up, productivity and wages are going down. And all of these matters raise our collective concerns at different times, in different ways, but this is the uncertainty of the world today. Political leaders, finally, are threatening popular responses, but these can only potentially increase and aggravate the uncertainty that I've just talked about. The response by politicians is not very adult-like. And you have, in the United States, candidates from both right and left who are reacting to these issues. If I'd been having this conversation 8 years ago when Barack Obama was elected as president, I would have said that we were in the process of electing the uncrowned emperor of the planet, because the US election dictates what happens to the rest of the world. Fortunately, or unfortunately, some of the ramifications of US foreign policy have led to a reduction in the perception that we are now living in a unipolar world. Other state actors have begun to assume more and more importance. Russia has reasserted itself. China and Japan can no longer be ignored. So we're going back to a bit of the status quo in terms of the political non-polarity that we had, but we're still far away from it. But in the US, the reaction of political candidates to these issues is worrying. One Republican candidate, you all know who I'm talking about, is blaming foreigners for the loss of US jobs. The Democratic candidate on the other side, who is the sort of following the front runner, is blaming trade for shifting jobs overseas and harming the American economy. And if you take a step back, the United States, which historically has been the anchor of the international trading system, is essentially presenting presidential candidates on both sides who are trade skeptics and opposed to the important agreements such as the Trans-Pacific Partnership, which I think is one of the biggest achievements of the current administration. So polarity on politics and continued uncertainty. That says a lot, and I've talked a lot about it. It's not unique to the United States. We're witnessing growing tensions between engagement and parochialism around the world. Leadership deficit is at its highest compared to where we have seen it before. So that's all the bad news. I'm going to stop there because we have to take the positive long-term view. Those of you who know me know I never say that the glass is half empty. It is always half full going towards full. We have to be optimistic about this. We have to find the mechanism to chart a course through this uncertainty and see where we go as a result of it. You can stay worried or you can find that route. I continue to believe in mankind's inherent innovative capacity and the ability to shape our future for the better. Tomorrow has to be a better day. But we have to predict this in an uncertain world. We have to predict this in a world where some of us have to crystal gaze, but a lot of us have to work with the given parameters of where we are. And what is it that drives my positivity? Two important, undeniable, inalienable facts: urbanization and the growth of demographics and the change within them. These trends are here to stay. Whether the Fed raises rates or not, whether the EU falls apart, whether the Koreas implode, these two trends are going to dictate and drive economic development in the coming 2 decades. Of course, there will be other trends, but these will be the driving ones. The global economy is shifting without question, east and west. The so-called emerging markets already make up more than half of global GDP on a PPP basis, and they're projected to get to close to 2/3 of that by the time we reach 2030. They're going to dominate every macro indicator in the medium to long term, and this is just a fact. This is not me talking. Across the world, everybody will tell you exactly the same thing. 2/3 of global growth, till 2030 is going to come from these markets and going to be boosted by South-South trade. 2/3 of global consumption is going to come from these markets and will continue to grow. Young, urban, middle-class consumers will fuel this growth. Rising disposable income is going to continue to be a trend of our lifetimes. And historic underinvestment in sectors that require them are going to combine and make economic opportunities come to the fore and drive development around the world. So this is going to lead to the emergence of a new world order and a very interesting world order. Let's deal with each of these in turn. Let's talk about demographics. One of the greatest achievements of the 20th century has been the dramatic rise in life expectancy, especially in the West and increasingly across the world. 100 years ago, we could have said, and I'm not very good at statistics, but I'll warrant that 2/3 of life expectancy that we expect today was present then, and a little before that, even less. What is truly remarkable, and this is interesting, is that developed countries are now facing a host of issues that are associated with aging populations, things that they haven't dealt with before. Increased healthcare, increased pension spending, lower dependency ratios. And as the West grows old, select markets across this world are going to benefit from a massive demographic dividend over the coming years as well. The median age in Nigeria is 19. Stop and think about that. It's 27 in Southeast Asia. Stop and think about that. It's 35 in China, and it's 40 in OECD countries. You've heard me say this before, when you're 40, you start thinking about different things. You start thinking about spectacles, healthcare, and saving rates. When you're in your 20s, you just want to spend more and more, you want to consume, you want the excitement of the life that MTV promises. And these demographic challenges and trends are going to reshape and define and dictate the composition of the world's population. By mid-century, we expect to have 10 billion people going forward. 13% of them only are going to be resident in developed economies today. 25% of those 10 billion people are going to be African. Africa is waking up at a rate which is unprecedented, and we've never seen this before. And it's waking up at a rate where it is beginning to understand what it wants. And this is going to drive a lot of our thinking in the years going forward. By the end of this century, most of us will not be around unless medical innovation takes us to a point where we continue to live for far longer, and I wouldn't bet my bottom dollar that that won't happen. But Asia and Africa at that point is going to comprise 80% of the world's population. That's then, but it matters to us now. Why does it matter to us? Because younger populations are associated with increased consumption and increased availability of cost-competitive labor. What this implies in turn is a shift in the geography of consumption. It implies a shift in the geography of manufacturing. The availability of this cost-competitive labor going forward in the future means that we will no longer just keep saying made in China. We'll also be saying made in Mexico, made in Bangladesh, made in the Philippines. 1 billion people, ladies and gentlemen, are moving into the consuming classes, into the consuming middle classes, just in the next decade. And most of these are going to happen in global growth markets, the ones that interest us and the ones that have brought all of you together in this room today. And so, in this 20-year period between 2010, and we're already 5 years into that, in these 20 years between 2010 and 2030, we expect middle-class consumption to grow 4 times greater than it was at the start of those 20 years. If you look at India, let me give you a staggering statistic. Every month, 1 million young Indians turn 18. Every month. That's a staggering statistic. And what do they want? They want jobs, they want access to goods and services, and they just want a better life, exactly like you and me. And that's 1 million people that only India has to serve, forget about the rest of the world. So this urbanization, this demographic dividend that I'm talking about, set against the backdrop of urbanization, we have to remember that globally, There are now more people living in urban areas than rural areas. We've never had that before. 35 years down the line, by 2050, we're going to have 2/3 of the world's population living in cities. We can argue whether that's a good thing or a bad thing, but it's just a reality. That is what is going to happen, and we have to deal with it. Developed markets today are largely urbanized already. And this urbanization trend that we're talking about is not going to stop. In absolute and relative terms, this growth is going to be phenomenal because we can talk about these numbers, imagine the infrastructure that we have to create behind it in order to accommodate it. And then you might understand the Chinese strategists who were building these large empty cities that a lot of us mocked in the past, talking about the investment trends as to why they were creating them. These cities are critical to accommodate the needs of the future. I remember saying earlier about the fact that 80%, 90% of the world's population is going to be African and Asian. Lagos alone, let's take one city within Africa. Lagos alone is going to grow by 500,000 people each year between now and the end of the decade. Now, it's important to look at Lagos in isolation. We have a very strong hypothesis in Abraaj that it is cities and not countries, and you heard that in the video. It is cities, not countries, that drive the economic opportunity. Countries that are growing, you can bet your bottom dollar. The capital city is growing at twice the rate of the rest of the country. Lagos, with 500,000 people increasing every year, you have to remember, is closer to Accra and has more in common with Accra in Ghana than it has with the territory occupied by Boko Haram in the north, 1,000 miles away. And that's going to dictate the composition of how politics plays out in countries like that. By the middle of this century, again looking forward, 9 of the world's 10 largest cities are going to be located in growth markets. And that includes Karachi, Delhi, and Cairo. And only Tokyo is going to retain its top 10 status amongst the developed markets. So cities are clearly the engines of development in the modern world. This is how we are going to grow as humanity. This is how society is going to define itself. And as a rule of thumb, we have to remember that a 20% increase in a country's urbanization rate is going to double the income per person that lives within it. A 20% increase in the urbanization rate is going to double the income per person. And cities in growth markets are now driving this global GDP growth that I've been talking about. Consumer expenditure per household, again, whether we look at Peru, okay, Santiago, Lagos, Istanbul, 50% higher than the national average. Bangalore is twice the statistical growth rate of India. I'm throwing these statistics at you because these matter. Often we tend as entrepreneurs to follow a rule of thumb. We tend to follow what we think is the right instinct going forward in the future. But the reality is you have to look at these underlying facts and statistics to define how you should be generating and developing your own business plans and your own strategy going forward. And what we're going to see playing out is not actually any different from what we saw in the West from the 1950s onwards. And we're going to see that this rapid rise in urbanization, increase in consumption and wealth is just happening faster and at a more global scale than what happened in the West, but it's happening at the same rate, same style, and same approach nonetheless. The world itself, ladies and gentlemen, is undergoing a transformation, which is economic, it's social, it's political, it's demographic, it's physical, and it's not about to stop. And that's the world that you have to face. Overlay on top of that the technological innovation that's going on. I'm no expert on the way technology is changing. I spent a week in Silicon Valley with my good friend Fadi Ghandour just to find out if I was a dinosaur. And the reality is I am a bit of a dinosaur. I'm making every effort to try and change that. Abraaj is making every effort to try and change that. But the reality is that pace of technological innovation, the way in which services and goods are being delivered to people is being redefined to the extent that it is going to lead to disruption and elimination of certain industries that we are seeing today. We've already seen that in the growth of businesses like Careem. I'm not going to mention its largest global competitor, which goes by a strange 4-letter word that starts with U. But Kareem is going to redefine the way in which people look at transport here in the Middle East. And many businesses like that, Airbnb globally, and other sectors, financial services, insurance, healthcare, all of these are going to be innovated beyond recognition and beyond understanding compared to where we see it today. So how does this very positive thinking on the global trajectory as far as opportunity is concerned translate into strong investment opportunity? We at Abraaj have been extremely critical for a very long time now on acronym-based investing. Just like we hate the use of the word EM, we hate the use of the word BRIC. We never actually fundamentally understood what Brazil and Russia had in common with India and China, which were the two powerhouses of growth in the global economy in the last 2 decades. And because we've been cynical and skeptical about it, we've built our business around what we call global growth markets, not acronym-based investing. It bears repeating, and you've heard me say this before, but I'm going to say it again. EM, as people defined it, is very different and differently impacted as well by today's events. So it's useful to think of EM actually, as people define it, in 3 buckets. This is very important. Look at China in isolation, look at commodity-oriented economies in isolation, and look at private consumption-driven economies in isolation. Let's start with China. First of all, it was completely wrong to call what was arguably the largest economy in the world. If it's not there now, inexorably it will be there within the next few years. It is wrong to call it an emerging market. Equally, it is wrong to be obsessed with China's growth the way we have. We keep talking about the fact that the world is fundamentally impacted by China growing at 6% versus 8%. Set that against the backdrop of the United States, which for the last 5 years, every single year has been predicted to grow at 3%. Forget about the fact that that is half the rate of growth of China, but recognize the fact that every single year in those 5 years, it's come in at 2%, not 3% as projected. That's a 50% reduction against its targeted growth rate, and that is equal to the economy of Germany. And that's a very important fact as well. So a slow China still grows at 2.5 times the rate of a fast US. We aren't talking about contraction or stagnation. We're talking about an economy that told us with a lot of clarity, just like the Saudis told us with a lot of clarity, that they're going to maintain their supply positions, and hence the only impact that it can have is the price of oil will come down. In a similar way, China told us that we are going to move to being a consumption-driven economy as opposed to an investment-led economy. We're done with the investment side. We're talking about decelerating growth in one area, but accelerating it accompanied by structural changes in the economy in the other. The volatility of Chinese stock markets in the last few months has not been a good proxy for the economy. And what do I mean by that? There's been no correlation, actually, between China's growth and the Shanghai Composite Index. There is a fundamental difference and problem with the way that we look at measuring China's GDP. China is actually 2 very different economies within itself. The old one is based on industrial output. The old one is looked at in that light. The new China is based on services and is starting to be more and more consumption driven. So the old one is looking at China and looking at a Foxconn factory that churns out iPhones. The new China is about seeing long lines of people standing outside an Apple store and clamoring for the latest device. Measures of China's GDP today focus heavily on the old economy, and that's no longer the case, right? The industrial sector, it's no longer the case as a barometer for growth. It is the services sector that we should be measuring, and within that, within China, the situation is not as bleak as some may say. Millions of companies were created last year alone, concentrating in tourism, in healthcare, in sports and education. So they're beginning to serve the domestic economy. They're coming up. The spirit of entrepreneurship is being encouraged. And I think that as we achieve clarity on the way China is growing, that is what we're going to see will be driving the economy. Wages within China are growing at more than 10% annually. They're driving consumption. Contrast that with developed markets, ladies and gentlemen, where wages are remaining stagnant. I won't deny that if China's industrial sector falters, it'll have negative impacts for the rest of the world. Of course, it will, by definition. But that's not the only thing we should look at. A rising middle class in China is going to be driven by higher wages, and it'll offset some of that negative. Hopefully, equally, maybe not. And that same view drives our analysis of our markets and the way we look at our business. These markets are where consumption is going to continue to grow, driven by urbanization and larger incomes at a higher rate. Now let's move to the second bucket in which I define EM, and that is the commodity-oriented economies. Commodity-oriented economies driven by, let's start with oil, for example. These are the real sufferers of the slowdown that we're experiencing and seeing today. Brazil and Russia, my two favorite topics that I keep talking about as a bad example of acronym-based investing. They're going to stagnate or contract by close to 1% in the coming year. Beyond the unfavorable commodity prices that they face, both economies will continue to have very severe macroeconomic problems. And they failed to leverage the commodity super cycle that we've experienced over the course of the last decade to prepare their economies for better times. And countries that are extremely dependent on China as well, such as Angola or Zimbabwe, are going to be especially hard hit, and are countries that we need to watch from a structural perspective as well, because not only are they going to suffer from reduced trade, they're going to suffer from reduced FDI. And then, even within this category, like I did in China, we have to differentiate and stop and think, because some of those traditional commodity-driven economies have diversified, such as the UAE, where you are today. Look around you and you'll understand what I'm saying when I say that case in point is when you move towards the services economy, when you move to diversify your economy, when that negativity happens, you do not continue to be negatively hit. Oil revenue in this country accounted for 90% of its GDP at the time of independence in 1971. Today, it's down to 30%, and that's an amazing statistic. Not to forget that these GCC oil exporters have got massive reserves of foreign currency reserves that continue to buttress their economies. Saudi Arabia alone has close to $600 or $700 billion, and they're coming under pressure, but they're beginning to understand how to deal with that pressure as well, and that's an important point. Now, let's move to the third category, which is the private consumption-driven economies. These are the markets in which Abraaj invests. These are relatively insulated from fluctuating global trends. It's important to know that because lower oil prices results in a stimulus to these economies. They have used that lower oil price opportunity to actually continue to propagate growth and development. They are not as massively impacted by a Chinese slowdown, but unfortunately, these markets receive a disproportionately low quantum of interest from CNN and global headlines. These are the markets we invest in. These are the markets where the average percentage of GDP growth, which is attributable to private consumption, is 60 to 70%. 43% in BRIC, 34% in China, and these markets are growing at 60 to 70% driven by private consumption. Consumption in these markets is a resilient story. So if you see how I've tried to diversify away from what the headlines say and where the opportunity lies, you'll see that a growing number of people in these markets are better off. They have increased wages, they have disposable income, they have consumption opportunity, and although the inequality gap in developed markets may be smaller, interesting, in absolute terms than our markets, the reality is that it's going in the wrong direction, that inequality gap. Whereas, and the middle class in the developed markets have seen their share of consumption and economy shrink, whereas in our markets, we're seeing it increasing. And that's a very, very important point. So that's the backdrop that I wanted to place in front of you of how these markets and opportunities are playing out. There is uncertainty, as we started off by talking about, and then there is enormous opportunity, specifically where you want to look for it. Abraaj continues to be extremely well situated in today's uncertain environment to both capitalize on that opportunity and to drive positive change in today's world. You know, as a business, one of the reasons why you have understood our mission is that we're not just driven by shareholder returns. Shareholder returns are critical. I have many shareholders in the audience that have seen our growth and have been satisfied by the returns we generate, but that's just one component of what we do as a business. Our stakeholder engagement is what drives our DNA, defines our identity, and will propel us into the future. And in the midst of all of these jittery markets, falling indices in markets that the world considers important, we have continued to prosper because the fundamentals of the markets in which we are investing are only getting better and better. I'm not saying that they will continue to grow in this manner. There will be challenges, there will be issues, but what we're doing in these markets is differentiating ourselves and going down a direction which is arguably more interesting for these cities and countries than they were before. Private sector within these markets have an important role to play. It has the ability to have a lasting impact. It has the ability to create change. And at Abraaj, we have responsibility for three very different sets of stakeholders: our investors, our partner companies, and the local communities in which we operate. I deliberately didn't say at this point our employees and their families, because once we've satisfied these three communities, our employees and our families will be taken care of almost by definition. Sometimes people put their values the other way around. In our case, we're very clear about what we seek to do, because so long as we keep doing that, so long as all of you remain aligned, we will continue to drive opportunity. Now, we will continue to drive and see that and unearth that. We will continue to invest into our markets. You've seen a bit of a slowdown in our investment speed because we're seeing that markets are readjusting to pricing levels, and we want to be left with enough opportunity to exploit that as we go forward. Mustafa will talk to you about that in a little bit more detail this afternoon. But certainly the trend and the directionality is moving in the right direction. The last point I want to make is that all of you have seen us over time talk about the spirit of partnership in engaging ways. We refer to companies that we buy, unlike the global private equity industry that refers to them as portfolio companies. We've always called them our partner companies. We've always embraced the spirit of partnership. And hence, the more we think about this going forward, the more we've understood that in global growth markets, EM, if you really want to continue to be a dinosaur, but across these global growth markets, the private equity industry has redefined itself and should refer to itself as a source of partnership capital, because it is these partnerships that are going to enable us to grow. It's these partnerships that are going to enable the market to understand the opportunity that we have. Difficult times ahead, superior execution needed, local knowledge of critical importance. Our central bank, if you like, of operational expertise and investment expertise will continue to be augmented. We'll continue to roll out new products and new opportunities, and we'll continue to try and remain diligent in our evaluation of those opportunities. We'll continue to try and keep pace with the world of technology. And the companies and the consumers in our markets, which are often quicker to adapt to this technological change, will continue to keep us on our toes, and will continue to drive opportunity in ways that we didn't think. We're learning this, you're learning this, and we're going forward. Because this new world, in which online retailing alone is expected to grow at double digits, data traffic is expected to grow tenfold in the next 5 years, and 3 billion smartphones globally, ensuring connectivity at a level that we haven't thought of before, and you'll understand why disruption in technology is of crucial importance as we go forward. So many challenges, but even more opportunities. In the big picture, we as a firm are a very small part of the effort that is required to improve our collective well-being in the world that we inhabit. We continue to want to do our role. We continue to want to change the way in which we approach these markets. We continue to want to change the way in which we serve these markets and serve you. So I hope that my ideas and thoughts, disjointed as they may have been, help to provide a platform on which we spend the rest of the day discussing opportunities, risks, challenges, and at the same time, hopefully translating into rewards. I hope this has been a useful perspective in how we can all shape our collective future. There are people here from close to 75 countries around the world. We hope that together we can shape this common understanding. We understand that it requires adaptability, it requires flexibility, it requires an ability to think out of the box, often radically. It needs to have an ability to think like an entrepreneur, like an operator, like an investor, sometimes differently, often together. I keep telling my colleagues that you have to be all three, and often they're schizophrenic in thinking, but you have to be all three all day long, every day, because that is the only way that you can swiftly implement ideas and processes. But ultimately, ladies and gentlemen, it's about thinking long term. It is about not getting excited about the volatility and of the immediacy. It is about understanding that where we are today, you as investors, operators, stakeholders, and us as a firm that serves you, it's very important to remember that we're not alone in this thinking. Global multinationals understood the opportunity in these markets a long time ago. So when you disaggregate the earnings of Coca-Cola or Nestle or Nike or Kimberly-Clark or any of the big global firms, you will see that the opportunity that they are experiencing in our markets is growing close to 3 or 4 times the opportunity that they're experiencing in developed markets. And contrast that with firms like General Mills that haven't come into these markets, which are not experiencing anywhere near the same rate of growth as our opportunity. So we're all global citizens. We need to have a positive outlook about the future. We can't switch off and say, come back and call me when the world is a better place, because it's going to be a very long time before you can define the world as being a better place. It has its challenges. That's what makes it beautiful, but it's ours. The Oxford report last year on threats, developments, and opportunities concluded this is the best time to be alive. And I certainly know that I don't have any alternative to another time to be alive. So I fully intend to make the most of it. Thank you very much for being here. I hope that we will have the opportunity to exchange many ideas during the course of this day and in the years ahead. Thank you very much.